Let me ask you something. If I gave you two choices right now, option one, you buy property, land, buildings, something you can touch. Option two, you buy stocks, pieces of companies you may never physically see. Which one would you choose? Most people answer that question instantly. They say, real estate, of course, because it feels safer, it feels real, it feels like wealth. But here's the uncomfortable truth. The thing that feels like wealth is not always what actually builds wealth. And in the next few minutes, we're going to break this down in a way most people never do. We're going to compare real estate and stocks, not just on the surface, but in terms of how they make money, how fast they grow, how risky they really are, and most importantly, which one is more likely to make you rich. And I promise you, by the end of this, you'll look at money very differently. So stay with me, because the biggest mistake people make with money is choosing the wrong vehicle. Now, before we go any further, let's clear something up. This is not about which one is better, because both real estate and stocks have created millionaires, plenty of them. This is about understanding how each one works, so you can choose the one that fits your life, your goals, and your personality. Because if you pick the wrong one, you won't just grow slowly, you might quit entirely. Let's start simple. What is real estate? Real estate is exactly what it sounds like: land and anything attached to it. Houses, apartments, commercial buildings. When you invest in real estate, you're buying a physical asset, something you can see, something you can touch, something that, in most cases, people will always need, because no matter what happens in the world, people need a place to live. Now, what about stocks? Stocks are ownership in a company. When you buy a stock, you're buying a tiny piece of a business. That business could be making money or losing money. It could grow or collapse. But here's the key difference. With stocks, your wealth is tied to the performance of a company. With real estate, your wealth is tied to the value of a physical property and the income it generates. So already, you can see the contrast. Real estate feels stable. Stocks feel unpredictable. And that's exactly why many people avoid stocks. But here's where things start to get interesting. Because what feels safe is not always what is safe. Let's talk about how each one actually makes you money. Real estate makes money in three main ways. Number one, cash flow. That's the rent you collect every month. If your tenants pay more than your expenses, you make money. Simple. Number two, appreciation. Over time, property values tend to go up. So the house you bought for $50,000 might be worth $100,000 in the future. Number three, leverage. This is where real estate gets powerful. Because you can borrow money to buy property, you might only put down 10%, but you control 100% of the asset. That means if the value goes up, you benefit as if you owned the whole thing. Now let's look at stocks. Stocks make money in two main ways. Number one, price appreciation. If you buy a stock at $10 and it goes to $20, you've doubled your money. Number two, dividends. Some companies share their profits with shareholders, so you get paid just for owning the stock. At first glance, real estate seems like the winner. More ways to make money, more control, more realness. But here's where most people get it wrong. They underestimate the power of stocks, and they overestimate the simplicity of real estate. Let's talk about growth, because at the end of the day, we're not just trying to make money. We're trying to grow money. Historically, the stock market has returned about 8% to 10% per year on average. That might not sound exciting, but over time it becomes explosive. Because of one thing: compound growth. And if you don't understand this part, you're missing everything. Imagine you invest $1,000 and it grows at 10% per year. After 1 year, you have $1,100. After 2 years, you're not just earning on your $1,000. You're earning on your $1,100. That's compounding. And over 20, 30, 40 years, it turns small amounts into massive wealth. Now, here's the twist. Real estate doesn't compound the same way. Yes, property values go up, but they don't multiply in the same exponential way stocks can, unless you keep buying more properties. Which brings us to something important. Real estate is active. Stocks are passive. If you invest in real estate, you're not just an investor, you're a landlord. You deal with tenants, maintenance, repairs, vacancies, unexpected costs. It's not just money, it's time and effort. Stocks, on the other hand, can be completely passive. You can invest, sit back, and let time do the work. No tenants, no phone calls at midnight, no leaking roofs. So now the question becomes, do you want to be active or passive? Because that decision alone can determine your success. But wait, it gets deeper. Let's talk about risk, because this is where things get misunderstood. Most people think stocks are risky because prices go up and down every day. You see red numbers, you see volatility, and it feels dangerous. But real estate feels calm, stable, safe. But here's the truth. Real estate has risk too. You just don't see it every day. If the market crashes, stock prices drop instantly. You see it. It's visible. But when real estate drops, it's slower, less obvious, but still very real. And there's another layer of risk in real estate: debt. Because most people use loans to buy property, and debt amplifies everything. If things go well, you win big. If things go wrong, you lose big. Stocks don't require debt. You can invest with whatever you have, even small amounts, which makes them more accessible. Now let's talk about something people rarely consider: liquidity. Liquidity means how quickly you can access your money. Stocks are extremely liquid. You can sell them in seconds and get your cash. Real estate, not so much. Selling property can take months, sometimes longer, and during that time, your money is stuck. So if you need quick access to cash, stocks have a clear advantage. Now here's a powerful question. What kind of life do you want? Because this is where everything connects. If you want freedom, time, flexibility, stocks might be the better path. If you want control, tangible assets, and the ability to scale with leverage, real estate might be your path. But here's something most people don't realize. The real winners don't choose just one. They combine both. They use stocks for passive growth and real estate for cash flow and leverage. Because wealth is not about picking sides. It's about building systems. Let me give you an example. Someone invests consistently in stocks for 10 to 20 years. They build a strong portfolio. Then they use that wealth as a foundation to invest in real estate. Now they have both passive income from stocks and cash flow from property. That's how wealth compounds across different assets. But if you're just starting, here's the honest answer. Stocks are easier. They require less money, less time, less stress. Real estate requires more capital, more effort, more knowledge. So if you're starting from zero, stocks are often the better first step. But, and this is important, that doesn't mean real estate is bad. It just means timing matters. Now here's the part most people ignore. Consistency beats strategy. You can pick the perfect investment, but if you don't stay consistent, it won't matter. And this is where people fail. They jump between strategies. They chase trends. They quit too early. Wealth doesn't come from picking the smartest option. It comes from sticking with a good option long enough. So instead of asking, which one makes more money? Ask this: which one can I stick with for the next 10 years? Because that's the real game. Now let's go deeper. Let's talk about mindset. Real estate investors often think long-term. They think in decades. They think in assets. Stock investors often get distracted by short-term movements, daily prices, news, fear. But the ones who win ignore the noise. They think like owners, not traders, and this applies to both. If you treat stocks like a casino, you'll lose. If you treat real estate like a shortcut, you'll struggle. Both require patience, discipline, and a long-term vision. Now, here's something you need to hear. There is no fast way to wealth. Real estate won't make you rich overnight. Stocks won't make you rich overnight. But both can make you wealthy over time. And that's the difference between people who succeed and people who stay stuck. One group is looking for speed. The other is building systems. So where does that leave you? If you want simplicity, start with stocks. If you want control and are willing to put in work, explore real estate. If you want the best of both worlds, build both. But whatever you do, start, because the biggest risk is doing nothing. And if you've made it this far, you're already ahead of most people. So here's what I want you to do next. Think about your situation, your income, your time, your goals, and choose your first step. Not the perfect step, just the first one. Because clarity doesn't come before action. It comes from action. And if this opened your eyes even a little bit, make sure you stay close to content like this, because understanding money changes everything. And one day, you'll look back at this moment and realize this is where it started.